want to welcome everyone. Thank you for joining us for today's session of tax risk for health systems. My name is Kim Hunredson. I'm partner in charge of exempt organization tax at Eide Bailey. I have over 25 years of experience working with exempt organizations on issues specific to their tax status and work with a number of large integrated health systems. So have experience working with organizations in these types of complex arenas. We're going to start off today talking about, to start with, some qualifications under 501c3. And as we think about this session, understand that not all health systems are strictly organizations that are exempt under 501c3. So we do understand that a lot of health systems have both taxable and exempt entities within them. So we'll try to address both sides of those issues. And this session really was developed as I think about the role of a tax director within a health system, and thinking about if I was a tax director and thinking about all of the different hats that this individual wears, what are those potential areas of tax risk that a tax director or someone within the tax role needs to be aware of? And I think it's easy for us to always default to just thinking about the compliance pieces, so the actual tax returns that have to be filed, because those are deadline driven. So we know when we have to think about getting our Form 990 filed, our Form 1120 filed, maybe our payroll tax returns. Those we can put on a calendar, and we know that we have to think about it. So while those are very important and are things that we need to make sure we're thinking about, there's also other types of tax risks that can exist within an organization that, as the person responsible for tax, you need to be aware of and thinking about. Some of them maybe you don't have to think about on a daily basis or even a monthly basis, but instead there should be policies or procedures in place to make sure that we are addressing them. We also need to just keep in mind that sometimes the things that we're talking about aren't necessarily things that you directly control. So for instance, payroll taxes may or may not fall within someone who has ultimate responsibility for tax. That might be outsourced to your payroll department. Sales tax may or may not fall within a tax department. It might fall within our AP department. So a lot of these issues are things that are outside what might be typically considered the tax department's responsibility. So we're going to start with talking just big picture about tax exemption risk, because in most situations, at least with the organizations that we're working with, in most situations, the majority of the entities within the system are tax-exempt entities. So we want to make sure that we're maintaining that tax exemption, because as you think about it, tax exemption is really one of the biggest assets that the organization has. If you were to lose your tax-exempt status, all of a sudden all of your net income is going to be subject to federal and probably state income tax. You may lose tax-exempt bond financing. You may now be subject to property taxes and sales tax and other types of things that would have a significant implication on the organization. So ensuring that the organization is operating in a manner that they're not putting their tax-exempt status at risk is really important. So with that, let's start with just the general qualifications under 501c3. So in order for an organization to be exempt under 501c, it has to meet both an organizational and an operational test. That organizational test really goes back to your articles of incorporation, your organizing documents. So if you are a 501c3, you would have gotten there because your articles were limiting the purposes of the organization to those things that are charitable. You've got to have a dissolution clause that says once those assets are within the charitable world, you can't take them out of the charitable world. So in other words, if your entity were to be dissolved, those assets have to go to another 501c3. Really, from an overall standpoint, it's the operational test where we can sometimes get into trouble and where we need to be thinking about, are we doing anything within this operational test that could potentially risk our tax-exempt status? The operational test says that the organization has to operate primarily for exempt purpose. So you see it's not an exclusivity component, and that's really what allows an organization to have some activities that aren't charitable, that maybe are subject to unrelated business income. But your primary activities must be charitable. Within the operational test, there's concepts under private benefit and inurnment, political activities, and lobbying activities, all of which we're going to address. So these are the issues that I just mentioned as that benefit of 501c3 status. All right, starting out with private benefit. So this concept says that an organization has to operate to serve public versus private interest. And overall, what this means is that an organization has to be operated to benefit a broad group of people. It can't be specific to a small group of entities or individuals. Private benefit is where things can come up within this context that really can potentially jeopardize tax-exempt status. So where we see private benefit, especially in a healthcare arena, is thinking about any transactions that the organization may enter into where there's benefit being provided to an individual, or it actually could be to another for-profit entity. Because again, those assets have to be used for charitable purpose. Concepts where we might see this apply is physician transactions. So if you are going to do a physician practice acquisition, you need to ensure that the transaction itself is being done at fair market value so that you can say the exempt assets are not unfavorably being used for a private person's benefit. We can also see this happening in joint ventures with for-profit entities where there may be some potential transaction benefits if you don't have the joint venture structured in a way that both parties are getting equal or relatively equal benefits. We can also see this in physician recruitment with respect to the benefits or the compensation that's being provided, or even in an overall compensation structure. If we have potential for compensation to be unreasonable, if you think about a revenue sharing or revenue-based compensation that doesn't have any kind of upper limits on it, an individual could get to a point where they, based on their revenue, could be compensated more than what's really reasonable for their position. So private benefit is really what drives the need and the importance of having valuations done anytime you're entering into transactions with either individuals or taxable entities. Private inurnment is similar to private benefit, but private inurnment is looking at benefits to individuals who have control over the organization. So these are the types of transactions where you're entering into compensation agreements or other types of maybe rental agreements, lending agreements, sales or purchases with individuals who are in a position to influence the organization. These are the types of transactions where it's important for you to have conflict of interest statements and conflict of interest policies that really dictate what types of transactions the organization can enter into with individuals who control the organization or with entities that those individuals are involved in. Unlike private benefit, where there is actually an ability to have some private benefit within an organization, private inurnment is not allowed and can result in revocation of exemption. Because of that, the IRS put some rules in place to limit the potential that an organization would lose its tax-exempt status because of private benefits. And these are called the intermediate sanctions. These have been in place now for over 10 years. And really it's designed to penalize the individual who benefits from a transaction versus penalizing the organization by revoking its tax-exempt status. And these sanctions apply whenever there is an excess benefit that's given to a disqualified person. So common places where we might see this is compensation. So let's say that we determine that reasonable compensation for a CEO is $750,000, but the organization chooses to pay $1 million. That $250,000 is a potential excess benefit transaction. Could apply those same types of analysis to purchasing services from a board member, and you're paying more than fair market value for those services, or buying property from a board member's organization that they're involved with, and you're paying more than fair market value. And again, that disqualified person is any person having the ability to exercise influence over the organization. These penalties are steep, so it's a 25% of the benefit received on the first tier, and if that penalty isn't paid and corrected, in other words, the amount of the benefit given back to the organization, then it becomes a 200% penalty. So that can be very steep if the IRS becomes aware of this and imposes the penalties before the correction is done. There's also a penalty on organization managers who knowingly entered into the transaction. So if your board approved a transaction with one of its board members that they knew was in excess of fair market value, those board members individually can be held accountable for penalties of up to 10% of the excess benefit, but that penalty is capped at $20,000, and that total is for all managers who were part of that process. So things that the organization can do to help counter the potential for these penalties and really shift the burden of proof to the IRS. These processes are called the rebuttable presumption of reasonableness. So 3 different things that have to be met. The transaction needs to be approved by an independent board or a group of persons who are unrelated to that disqualified person. Your documents must have in there the determination of the approval of the transaction, and they rely on comparable data prior to approving the transactions. One of the places we do see this coming up more regularly, not on a regular basis, but in the case of fraud, the IRS has said that in a situation where the organization is defrauded by maybe their CFO or someone who's in that position, that fraud does become an excess benefit transaction. Again, putting that penalty on the individual who benefited, not on the organization, but it is the organization that ends up reporting it because there's questions on the tax return that require that reporting. So key takeaway on this is really for an organization, you should have a process in place to identify who those disqualified persons are with respect to your organization, and ensuring that you've got conflict of interest policies and procedures in place to ensure that you know when the organization could potentially be entering into these types of transactions. And we are at our first polling question. So under the intermediate sanctions, these apply if there's an excess benefit transaction with a disqualified person. And that's a true or false. Oh, people did well. The answer is true. Political activities is another potential area where an organization could jeopardize its tax-exempt status. So 501c3 organizations are prohibited from doing any political activities. And a political activity is campaigning for or against a political candidate. In this area, I don't see this happening a whole lot, especially in health systems. I think the area of concern here is making sure that if leaders of the organization are talking about political issues, that they are speaking from themselves and not speaking on behalf of the organization. Ideally, individuals who are in leadership roles will not hopefully be publicly speaking about political issues, but making sure that there is that disconnect, that they are not speaking on behalf of the organization. Lobbying. Organizations are permitted to do lobbying as long as it does not become substantial related to the rest of their activities. So lobbying is attempting to influence legislation. So speaking to members of a legislative body specifically for the purpose of supporting or opposing pieces of legislation, which is different than what's more of advocacy, where you're maybe meeting with legislators and talking to them about issues that are important to your organizations or issues that are important to the industry as a whole. Lobbying, you do need to be reporting that on your 990. We typically see, organizations looking at lobbying based on the dues that they're paying to some of their state or national hospital associations. A portion of that is typically reported back to you as being related to lobbying. But we also see organizations who may themselves be engaging lobbyists to go and talk to legislators, or they may have internal staff that is doing lobbying, which also needs to be reported. So those are the key components where we really have the potential risk for jeopardizing tax-exempt status. Another area that can be a risk is unrelated business income, especially if that becomes substantial. So unrelated business income, so these are the trades or activities that an organization enters into that's operated with a profit motive, and they need to meet all three of these requirements. So it's operated with a profit motive, it's regularly carried on, so it's not just a one-time thing that the organization is doing, but it's an activity that you're doing on a regular basis, and specifically, where you're in potential competition with other for-profit entities that are conducting similar activities. And the most important, it's unrelated to your tax-exempt purpose. So these rules are put in place to curb competition between tax-exempt entities and for-profit entities, and not to curb the competition. So it's not to say that you can't conduct these activities, but if you are going to conduct activities where you're directly competing with for-profit entities, that you're also going to pay tax similar to what the for-profit entities would be paying. If you have unrelated business income, you can allocate ordinary and necessary business expenses related to that. This is one of the areas that's been on the IRS's priority guidance for the last couple of years. So their priority guidance plan is the plan that says this is where we think the exempt organizations group within the IRS needs to focus time. So they have indicated that they are going to be coming out with guidance as to what they feel are reasonable methods for allocating expenses. Right now, that guidance is pretty loose with respect to how organizations conduct the allocations. Income is taxed at regular corporate rates. So currently, the corporate rate is 21%. Similar, the same tax rate as if you have taxable corporations within your affiliated entities. Organizations that have both taxable entities and exempt organizations who have unrelated business income are subject to the controlled organization rules, which would, or controlled group rules, which would basically say that some of the special allocations that are available for tax purposes have to be allocated between all members of the controlled group. So exempt organizations with UBI do end up falling into those controlled group rules. We probably will see less impact on the control group rules now with the tax rate being a flat 21%. In the past, you would allocate the 15 and 25 and 34% brackets between your entities. As I mentioned earlier, if you have substantial unrelated business income that can result in loss of tax-exempt status, there's no bright line test for what is substantial. We could find rulings that would say 2 or 3% is substantial of your revenues, and some rulings that would say you could go up to 50%. We typically would say if you're somewhere around 15 to 20% of your revenues of your activities being unrelated business income, that's probably where you have some risk, and that's where it might make sense to think about restructuring. So maybe dropping that activity down into a taxable subsidiary. Really doesn't change anything because it's taxed the same way, but it provides you with that insulation from jeopardizing your exempt status. Right, everyone is familiar with the impacts, 2 impacts from the Tax Cuts and Jobs Act that are specific to unrelated business income. The first is the requirement to silo unrelated trade or business activities. In other words, to the extent that you're conducting more than one trade or business, the losses from one trade or business can no longer be used to offset income from another trade or business. Instead, those losses can only be carried forward to offset income in the future. We have some guidance on how these rules should be implemented, and at this point, that is guidance only. We anticipate additional information coming out, but at this point, you do need to determine how you're going to define your trades or businesses. And then the second impact is the qualified fringe benefits, aka the parking tax. By now, I'm sure all organizations have had to go through that painful analysis of looking at whether you have more than 50% of your parking lot being used by your employees, and if so, actually coming up with a tax that you're going to pay on the expenses that you incurred in providing that parking. Does not make sense, we know that, but it is still the law. We continue to see legislative proposals put out to eliminate actually both the siloing and the fringe benefits. At this point, they have not gotten approval through both the House and Senate to get removed, but we continue to hope that will happen at some point in the hopefully very near future. Just some general concepts with unrelated business income. There are exclusions, so your passive incomes, your interest, dividends, capital gains, royalties, and real property rentals are typically going to be excluded from that. However, if you have debt financing on any of those in assets that are generating the passive income, that debt financing can make the passive income taxable. There's also special rules with respect to interest, rents, and royalties from controlled entities. Some exceptions that we see commonly within the healthcare arena would be the convenience exception, so where you're providing services to your member or to your patients, to your employees, to your visitors. Think of your cafeteria, think of your pharmacy, think of your gift shop, or volunteer workers. So income from controlled organizations. Want to just touch on this a bit because it does have an impact if you're one of those entities that has taxable subsidiaries, or if you have transactions with other exempt subsidiaries that are generating unrelated business income. And this concept basically says that to the extent that an exempt organization is receiving rent, income, or royalties from an entity, from a controlled entity that is reducing its taxable income from the payment that they're making to the exempt entity, then the exempt controlling entity has to pick that income up as UBI. And the concept here really is that without this rule, there could be an opportunity for an exempt organization to charge a for-profit subsidiary excessive rent. The for-profit subsidiary would take a tax deduction for that rent, thus reducing their taxable income. And because there's an exception for rental income from UBI, the exempt organization wouldn't pick up that rental income, and there would be an unfair tax advantage. So these rules need to be considered whenever you have transactions between your exempt entities and for-profit entities. And like I mentioned earlier, it also applies in a situation where an exempt entity has unrelated business income and they're taking, a portion of the rent they're paying to the parent as a deduction on their unrelated business income. Within all of the types of transactions that you might have with controlled entities, even outside of interest, royalties, and rent, transfer pricing rules do apply. So in other words, the IRS can come in and they can challenge how those expenses are set up, because they're going to challenge the reasonableness. Anytime that you're reducing tax at a taxable entity and you're not picking up that tax at a consistent tax rate, the IRS will enforce the transfer pricing rules. Here's some common types of unrelated business income that we see within health systems. So pharmacy, that would be where you're doing non-patients, so you're making sales to individuals who aren't your patients. Providing management services, so management services to your taxable subsidiaries, management services to other entities, catering, laboratory services. We see a lot in the reference lab arena where there isn't a direct patient relationship that's being established, and instead you're just doing commercial testing very similar to what any other for-profit commercial testing entity would do. The last one here, alternative investments, is an area that we are seeing more of as health systems are entering into more complex investing situations and getting into some alternative investments. It's important to know that those alternative investments oftentimes are triggering unrelated business income. So many of the alternative investments are investments in partnerships, and when you're invested in a partnership, the UBI treatment is a look-through treatment. So the exempt organization has to look through that partnership and look at the activities that are conducted in the partnership and determine if those activities are related to the exempt purpose of the organization. And to the extent that they're not, then they get treated as unrelated business income. So this is an area that we see continually growing. I'm going to talk a little bit later about some of the other issues that we see with respect to alternative investments and other risks with those types of investments. So we have polling question number 2. In unrelated business income, what items can be considered other exceptions? So convenience of members, donated goods, both A and B, or none of the above. All right, so the exception is both A and B. So both convenience of members and donated goods are exceptions to UBI. So moving off of unrelated business income, I mentioned at the beginning the organizational and operational tests, and those are both requirements for any organization to be exempt under 501c3. We now have new rules that provide guidance as to how hospitals, in addition to those requirements, additional requirements that hospitals have to meet in order for them to maintain tax-exempt status under 501c3. So these rules came into place in 2010. They're nothing new. Everyone's been familiar with them now for quite a while. But I still think it's important to make sure that you keep them top of mind, because we are continuing to see that this is top of mind for the IRS, and it's top of mind for some of our congressional leaders. So just as a quick reminder, the 4 requirements are community health needs assessment. So an organization must complete a community health needs assessment once every 3 years. That document needs to be made publicly available, and there is a $50,000 per year penalty for failure to complete. Organizations have to have a financial assistance policy, which also needs to be made publicly available. There's limitations on charges, which says that someone who's eligible for financial assistance can't be charged more than the amount generally billed to individuals who are covered under other types of benefits, either Medicare, Medicaid, commercial insurance, and then billings and collections policies and practices. So an organization can't engage in extraordinary collection actions before they make reasonable efforts to determine if a patient's eligible for financial assistance. Again, these rules apply to any 501c3 organization that's operating hospital facilities. So if you have a hospital organization that uses one EIN number, but there's multiple facilities, licensed hospitals within that hospital organization, these rules apply separately to each of those individual hospital facilities. And if any one of your facilities is not meeting the requirements, then it's only that facility that loses its tax-exempt status if the IRS were to go to the extent of revoking tax-exempt status. And if you operate more than one hospital facility, the income from that non-compliant facility would then be treated as unrelated business income. These rules also can apply if you have a hospital facility that's operated through a partnership. Unless you're treating that partnership income as unrelated business income, the expectation is that that partnership, the facility operated by that partnership, is also meeting these exceptions. So we are seeing oversight with respect to 501R. When these rules came into play, there was an expectation that the IRS was going to conduct reviews for compliance with these rules. So they do review approximately a third of the total hospitals each year. So on a 3-year basis, they will look at all of the hospitals. A lot of times these reviews are happening without the hospital even knowing it's happening. So there's agents who are going out and are looking at your website to ensure that the documents are publicly available. They may look at other information that's in your 990, other public information to see compliance. The IRS is required to make an annual report to Congress on what they are seeing with respect to hospitals. The most recent report that was issued, which was in May 2018, one of the key things that was indicated in there beyond just what they were seeing with compliance with 501R was with respect to information on the 990 with respect to community benefits. And they did report that from 2011 to 2014, the amount of Medicaid was increased about 20.6%, probably because of Medicaid expansion. And charity care actually decreased by 16%. So that is concerning to people in the public, some of our legislators. So we anticipate, and we have seen, that there's going to be continued questions around, well, why would that be happening? The Senate Finance Committee is taking an interest in hospitals. Once again, our friend Senator Grassley is leading that charge. He has now sent 2 different letters to the IRS asking about this compliance with 501R. So there was a letter in February of 18 and February of 19. Some of the information I think is interesting with respect to this oversight is the IRS did indicate that from February of 18 to February of 19, they did 830 reviews of hospitals. Of those, 650 were closed with no further action. 130 of them went to a compliance check, which is more of a soft connection with the organization to ask some questions and help them, really more educational. And then 78 of those went to examination. Of the ones that went to compliance check or examination, 125 of the 129 were for financial assistance problems. So things that they found where the financial assistance policies weren't meeting the requirements. 14 of the 78 examinations were with respect to financial assistance. And they did indicate that none of the entities they reviewed had any issues with billings and collections and having the right information in there with respect to billings and collections. So we would assume then that some of the other issues would be with respect to community health needs assessments, or they may have been triggered for examination because of other issues outside of 501R. Polling question number 3. What is the Internal Revenue Code that hospitals have to meet the 501R exceptions or requirements for in order to maintain tax-exempt status? All right, the answer to this was 501c3. So the 501R rules are with respect to 501c3. So now moving away from the federal requirements and the federal tax implications, some other tax risks that are out there that organizations need to be thinking about and be aware of. The first is with respect to foreign reporting. So I mentioned earlier that we are seeing more and more organizations getting into alternative investments. And beyond UBI, the things that we are seeing with respect to alternative investments is the potential for having to report foreign activities. And these can be either direct investments or indirect investments. So some of the alternatives that organizations may invest in are actually foreign corporations or foreign partnerships. They might be hedge funds, they might be other types of investment funds. But to the extent that those entities are structured as a foreign corporation or a foreign partnership, anytime there's a transfer into a foreign corporation or partnership of more than $100,000, that triggers a foreign filing. And failure to file those forms with respect to those transfers can be significant. Those penalties can range from $10,000 to $100,000 per form. So it's really important to understand what type of entity you're actually investing in and whether these reporting requirements are being triggered. On an indirect basis, even if you're investing in a domestic partnership, that domestic partnership may in and of itself be investing into a foreign corporation or a foreign partnership. And again, because the tax reporting flows through to the partner, if your share of the partnership's investment is more than the threshold, you may have a reporting requirement because of that partnership's investment. Those types of transactions with a partnership are typically going to be in their footnotes that they provide. We are seeing that the footnotes are getting better. A number of years ago, it wasn't real clear. It wasn't real easy to get this information, but I would say overall we are seeing better information on footnotes, but it's really important that you know and have a good tracking for the types of things you're investing in and whether those are domestic or foreign, and then if it's a domestic partnership, whether there's any foreign transactions that are occurring within that partnership. Again, under the new Tax Cuts and Jobs Act, we do now have the excise tax on executive compensation. So this is the new 21% excise tax on remuneration paid in excess of $1 million or excess parachute payment. An excess parachute payment being a total severance package or a payment upon leaving the organization that's in excess of 3 times the individual's typical base salary. Under these rules, it's really important that an organization understands who their covered employees are. So a covered employee is one of your top 5 highest compensated employees. And once you are a covered employee, you remain a covered employee forever. So you are going to have tracking of who are your covered employees. Even if they currently aren't hitting that $1 million threshold, there's that potential that in the future, they could have a parachute payment that could trigger this tax. A couple of things that to keep in mind with respect to the definition of remuneration when you consider compensation. This is based on a calendar year. So even if you're a fiscal taxpayer, you would look at compensation paid within a calendar year, similar to the Part 7 reporting on the 990. It does not include compensation attributable to medical services. So this is where we're seeing that most organizations, if they looked at their top 5 highest paid, most of those are probably physicians. Because of this exception, you would take out any of those medical services, and if that eliminates the compensation entirely for your highest paid individuals, then you would continue to go down your list until you get to the highest paid individuals that aren't providing medical services. And it does include amounts when they're vested, not when they're paid. Under the notice that we've received, and the only guidance we have at this point, organizations need to make a good faith, reasonable interpretation of these guidelines, and they have said that following Notice 2019-09 is a reasonable good faith interpretation. Payroll taxes. So this is a focus area, another focus area of the 2019 compliance plan. So it relates to payroll taxes. And so they're looking at an increased focus here. And where part of this focus is coming from is the fact that within the last year and a half, the exempt organization group and the governmental group have now combined. And the governmental group, that people who used to just work on governments, they don't have a lot of tax issues other than payroll taxes. So those individuals are very familiar with payroll tax issues and payroll tax opportunities. And so we do expect to see more focus in the exempt organization area with respect to payroll taxes. This also is being driven by the fact that when they did the hospital reviews a number of years ago and the college and university reviews, they didn't find a lot of errors or issues other than in the payroll tax area. So issues that are going to be considered independent contractor versus employee, shared employees, and whether you're following the right rules with respect to proper withholding when you have shared employees, accountable plans, and then taxation of benefits. Under that shared employee, we're really looking at, in this case, they're looking at situations where you have 2 or more employers that are responsible for compliance with things like overtime, FLLA, FICA, FUTA, SUTA reporting. We see this a lot within hospital systems. is, especially as you might have employees who perform services for two different corporations, or they're transferring from one corporation to another, and making sure that you've got the proper payroll taxes being withheld. So some options that we see in this area: common paymaster arrangements, maybe managed or leased employee situations, or secondment arrangements. In all of these areas, the rules are pretty complex, and especially when you throw for-profit subsidiaries into them, they can increase the complexity. So this is probably one of those areas to maybe do some due diligence in, make sure that you've got good processes in place to ensure that you're either meeting like a common paymaster arrangement, or if you're leasing employees, that you're ensuring that you're getting those payroll taxes properly reported. Sales and use tax. So in general, many organizations that are tax exempt for federal purposes may also be tax exempt for state purposes. However, it's not an automatic. So you still have to meet the requirements of your individual state to determine whether the purchases you're making are going to be excluded from sales tax. And some of those exclusions are specific to the types of property or services that you're purchasing, and some of them are specific to the types of organizations. Even within some states, some 501c3 entities like clinics that are exempt from federal taxes may not be exempt from sales tax. And you may have issues where one entity is making purchases for all of your related entities. And in that case, you need to have systems in place to determine who is the end user. And if that end user is not exempt from sales tax, then you need to ensure that you're paying sales tax on that, or if you're not paying it, that you're remitting the use tax. So getting good processes in place. We are seeing states continuing to do audits in this area as they see it as an opportunity for revenue growth. Property taxes. Around the country, this is one of the areas that hospitals are facing more scrutiny in. So in general, property is presumed to be taxable unless you can meet an exemption. And that's going to require working with the local assessor to determine whether the property can meet an exemption. Single pieces of property can be both taxable and exempt. And in some cases, what we're seeing around the country with hospitals is assessors coming in and actually looking at who's using specific pieces of space within an exempt hospital. And to the extent that you have for-profit physicians or physicians who work for a for-profit entity coming in and using part of the space, they will then treat a portion of that space as taxable. Or if you have a separate legal entity that's taxable, you're going to have property tax typically on that space. So again, getting an idea of where are you paying property tax, where aren't you paying property tax, and does that make sense? Or are there some exceptions that you could meet that would minimize the property tax that you may be paying? Unclaimed property is another area that may or may not fall under your tax department, but unclaimed property is an area that states have gotten more aggressive in. And unclaimed property occurs when one party, so in this case our hospital, is holding property that belongs to another individual. So let's say that you've got a credit balance for a patient. After a period of inactivity, so if you've tried to return that credit to the patient and you can't get contact with them, you can't get it back to them, that property is actually, that credit payment is supposed to be turned over to the state, and then the state gets that property and holds it on behalf of that individual. So there are requirements that reports are being filed with the state to disclose the amount of unclaimed property that the hospital or any entity is holding. Some examples of what that could be: mention the credit memos or credit balances, uncashed checks of your employees. Maybe an employee left and never cashed one of their payroll checks, refunds that you're making, health savings accounts. So any of those types of things that technically belong to someone else, you should have procedures in place to identify what those are and make sure those are getting reported on a regular basis. We're seeing states actually hiring companies to come in and do audits on unclaimed property. Here in Minnesota, one of the areas that they did identify as an area they were going to focus on was with respect to hospitals. And the last piece that I wanted to bring up is charitable solicitations and registrations. So most states do require that if you are doing any kind of solicitations for funds within their state, that you need to be registered, and typically you need to file annual reporting to them. Now, most hospitals, maybe aren't going out and doing solicitation. Maybe you have a foundation, but you need to make sure then that that foundation is following these rules. Unfortunately, the rules are pretty complex and they vary from state to state. So 39 of the states plus the District of Columbia do require that you have to register within their state. However, the threshold for when you have to register changes by state, and each state also has certain entities that may be exempt from having to register with them. So for instance, some states will specifically carve out that hospitals are not required to register. But if you have one of your other entities, like your foundation, that's doing the solicitation, or maybe it's your parent company that does the solicitations, then that entity would be required to register. Most states require nonprofits to register and submit annual filings. The answer there is true. Most states do require that registration. I already mentioned that there are some exemptions to that based on the nature of the organization, the kind of solicitations, maybe the amount raised. For instance, Minnesota doesn't require you to register unless you raise $25,000 within the state. Other states would say that before you raise your first dollar, you need to register. There is a unified registration statement that was created by the National Association of State Charities officials, and this is, like it says, a unified registration that most of the states will accept. So you do one registration form, you can send that to all of the states. Unfortunately, some of the states require additional supplemental information in addition to this, but in general, it does reduce your overall compliance. There's also a number of organizations that specialize in charitable solicitation, in doing the registrations and doing the annual filings for organizations. So that is the end of the session with from an overall tax risk standpoint. I hope the takeaways that you have here is that while the federal taxes is kind of the easy, in some ways, the easy things to think about, there are lots of other pieces of tax rules that are out there that organizations can be subject to, and having good processes in place to know your risks, to assess your risks, and to ensure that at least someone is thinking about it on a regular basis is really important. And I just wanted to share with you some upcoming webinars that we have and events. So on August 23rd, there will be unique issues to consider with Medicare and Medicaid reimbursement. And this is part of our health systems series. There's overall risks in the healthcare industry coming in September. And then for those organizations that maybe have some critical access hospitals that are part of their system, we are doing a fall 2019 webinar series. That's typically a series of 5 different webinars that are on topics specific to critical access hospitals. And then we also are having our annual Critical Access Hospital Conference. The dates for that have just been announced, and so that's going to be in San Antonio, Texas, April 1st through the 3rd of 2020. Returning to San Antonio, we were there last year and going to try it again this year. And then just some overall business trends webinars that Eide is putting on. If you wanted more information on any of these specific topics that apply both to exempt organizations in some situations, but also to taxable entities.
All right, thank you, Kim. We do have 2 questions, so we can go ahead and answer those pretty quick. The first one here, would the dissolution clause rules also apply to the 501c4?
Yes, 501c4 rules do require that there's a dissolution clause, but they don't limit that it has to go to a 501c3.
And the second question here, if you have a check from a business versus an individual, do the same rules apply for sending those funds to the state?
Can you repeat that?
Yep. If you have a check from a business versus an individual, do the same rules apply for sending those funds to the state?
I guess, and that's in the unclaimed property. I don't know the answer to that for sure. I think that it does. I think it's both individuals and businesses, but I would be happy to look at that and come up with an answer. I don't know, Amy, if you have the individual that asked the question. Otherwise, if you wanted to reach out directly, my contact information is here and I can answer that offline.
We can do both. Okay. Well, those are all the questions that have come in. If you guys do have any other questions, please feel free to reach out to us. Otherwise, we will see you on our next webinar. Thank you, Kim.
Thank you.